You can see the Dow Jones Industrial Average up just 16 points. Not a very strong day for the market, trying to rebound off of yesterday's terrible more than 200 point sell-off. So a little dicey here in the early going. The market, however, did get one good piece of news this morning. New home sales in September rose at their highest level in more than 2 years. They were up 5.7%. That was more than the street expected. It boils down to an annualized rate of about 389,000 homes, which is good. I mean, this is up for a couple of years, but keep in mind that is not even a third of what this market was doing at the height of the housing boom. So still a long way to go, but another good sign for the housing market. Good morning, everyone. Welcome to the Markets Hub. I am Paul Vigna here with you today. We're going to jump into earnings, and there is one earnings story in particular that we want to talk about. I want to talk about Facebook, right? Yesterday, Facebook, after the market, reported some numbers that were better than the street expected. Probably caught a lot of people off guard. And you can see the stock today is rocketing, up 22%. I believe that is probably this stock's best day in its short shelf life here since the May IPO. To talk about it, we have Mark Hulbert from MarketWatch, who is ready to pose the question, and maybe not give you the answer you want, but is it time to buy Facebook? Mark, how are you?
Fine, thank you. How are you?
Now, you've been kind of hard on this stock. You were one of the first people to come out and really say that this is a stock that should be trading in the teens. How do you feel about it now?
Well, the basis of my prediction back in May that the stock would be fairly valued came up with a value of $13.80. That was at a time when, of course, right after the IPO in the 30s. The basis of that calculation was a back-of-the-envelope calculation. It's a relatively simplistic one. I'd be the first to say it's not a very sophisticated model. It simply looks at revenue growth and assumes that Facebook's revenue will grow at the same rate that IPOs did between 1995 and 2005. I got a fairly extensive database from some academic researchers, and I based the estimate on that. And if you go out 5 years and you assume a second assumption, which is a fairly generous one, which is that Facebook's price to sales ratio at that point would be the same as Google's is today, then you come up with a price. Turns out it was $13.80. And so when I do that same back of the envelope calculation in the wake of yesterday's earnings report, I get only a marginally better price, this time $15.93, still a lot lower than the current price.
Yeah, you know, the revenue growth yesterday, I mean, it did stick out to a lot of people. It was about 33%, I believe. I mean, a little better than what you were talking about. Does that weigh much at all?
Well, yes. I mean, it turns out the way I like to think about it is that if we weren't talking about an overvalued stock, then we could all celebrate what Facebook achieved. A 32% revenue growth rate is definitely something to celebrate. That's slightly above the average of what all IPOs did between 1995 and 2005. The curse of being so overvalued is that you have to grow a lot faster, not just a little bit, a lot faster than the average in order to support it. And that's, I think, the curse of what Facebook is having to face.
Yeah, so you look at the stock today, I mean, obviously a big jump for the stock today, up around $24, $23. You say it's worth 16, so your ultimate answer then is no.
Well, that's right. If you use the basis of the calculation, of course, I'm not an advisor, so I can't answer your question in any magical way, but is to say that, you know, the same calculation that said it was worth $13.80 when the stock was at 30s is saying it's now worth just under 16.
Yeah, and I guess that's the thing, right? I mean, look, you can take a look at this company and say, well, they're going to grow, they're going to try new things, they're moving into gifting and to selling commerce on the site. There's a lot of initiatives. I'm going to take a flyer on them. It's $23, $24. It's still well below the IPO, well below what it traded on that first day. There are obviously people who want to take a flyer on this company.
Oh, no doubt. Though the question is, are they looking at the same set of numbers that I am or any long-term investor would? I think a lot of them are relatively short-term traders who are going to play a particular bet on the earnings report or a momentum play, for example. But if you look at it over the long term, I think the numbers are unassailable. This company has to grow at an incredible rate. And given the fact that it's already a huge company, that's another thing to point out. It's going to be hard for its revenue to grow at the same pace as some of these tiny IPOs. After all, the percentage growth rate of those tiny IPOs is a lot easier when their market cap isn't already nearly, 60 billion or whatever it is right now.